Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will actually discuss tax considerations in private company transactions. So we have the privilege to discuss these issues with a tax accountant and business valuation expert in Franklin and Nashville, Tennessee, Brad Smith. One thing that I think might also be of interest to people is if you could just briefly describe kind of the difference between a stock sale and an asset sale, because buyers like one and sellers usually like another. And so maybe if just on a high level, because it's usually is a there's tax consequences that are favorable to each party on each different, a stock sale is what sellers prefer, but buyers prefer an asset sale. Talk to us a little bit about why buyers prefer that asset sale.
Well, sure. So, basically it comes back to that purchase price allocation and the buyer getting a new basis in all of those acquired assets. Everything from the depreciable property to the amortizable intangibles like goodwill, they get a new starting point for future deductions. So it's definitely a tug of war between buyer and seller to find that middle ground that works for both parties. So an asset sale, incidentally, also covers the acquisition of a disregarded entity, which is something I see more and more. But an asset sale is a little more direct if the selling entity has non-operating assets or assets that they want excluded. Variety of reasons. It is certainly a very direct way to transfer an ongoing business and allow the buyer to be selective about what they're taking. But conversely, an entity sale, which could be a stock sale, or perhaps the membership interests in an LLC, taxed as a partnership, those are becoming more and more common as well. And it really hinges on items that are very difficult to transfer. And it could be customer contracts that would be too difficult to repaper, is one example. A tremendous amount of titled property, like a fleet of trucks. There can be tremendous costs in moving all of those to new ownership. So an entity sale is very viable. And what is interesting is under the tax code, we do have elections available to us to treat a stock sale like an asset sale. So I never let the form of the transaction or the desired form slow us down. There are options that we can work through. It's just important that both sides understand the metrics and the pros and cons of what it means for both of them.
Yeah, and sometimes buyers just default to an asset sale. Yeah. Like that's just normally what they want, because sometimes when you have to do a stock sale or buying the whole company, you also have some of the liabilities that come, like not liabilities like debt, like, something happens in the future based on a sale from a year ago, they might have to have a warranty or some other issue that Sure. They have to deal with that they don't always like to do.